Welcome back to another segment of Ask Alex. This is a big one. This is one that I get all the time. You know, when I'm out talking to the community, when I'm randomly golfing and somebody has, hey, are you a financial advisor? Boom, I'm getting opinions. But inside the office, this is also a very important topic, and it has to do with annuities. Now, even me saying that word, most families are either gonna say, hey, I love annuities, or I hate annuities, okay? And it's important people understand annuities and what different types of annuities exist. Now, here's the thing, again, oftentimes it'll happen with people, it'll happen with advisors. You have to understand the landscape of annuities. There are 4 types of annuities out there, okay? I'm gonna start from the beginning and walk all the way through. If you have an annuity and you're not sure what type of annuity, how it works, how you pay fees, this is an important one. You need to talk to somebody you trust. You need to talk to an expert on this subject, okay? So if this is something that you have concerns about or questions about, please feel free to reach out and we can help educate you on this. So let's start from the beginning. First type of annuity is what I call a variable annuity. Now these got popular kind of in the 90s, the early 2000s, where it was the first time Wall Street could say, hey, we have this way to reduce risk, and that's a variable annuity. Now, historically, variable annuities do have risk and you can still lose money. Also, historically, the fees tend to be a bit higher because of certain words called a rider. Every time you hear the word rider, most of the time, not all of the time, there's a fee associated with a rider. What would be an example? An income rider, a death benefit rider, right? A mortality and expense rider. Historically, again, when you hear the word rider, there is usually, keyword usually, a fee associated with it. So variable annuities, again, those are the ones that do have some form of risk. You can still lose some of your principal inside of a variable annuity. Second type of an annuity, this is called a fixed annuity, okay? A fixed annuity is very similar to what the bank would use as a CD. Hey, it's a fixed rate, it's a certain duration or term. Example, hey, I have this 5-year fixed annuity and my rate is 5%. What does that mean? Well, it means it doesn't really matter what the market does. It's a fixed rate. Again, similar to what a CD would be at your credit union or bank. Hey, it's 5 years, it's fixed, there's no risk. Most of the time, there's not gonna be any fees associated with this type of fixed account, okay? So first type is variable. There is risk, and you have to understand how the fees work and how you make money, because it's usually based on the stock market. Second, fixed annuity. Again, it's similar to a CD. It's over a certain term or duration, and it is a fixed rate. It doesn't really matter what happens in the stock market. Third type of annuity. These are called fixed indexed annuities. One of the common best practices I'll always tell families when we're talking about annuities, just break down the words. Let's break down the words. Fixed, well, that means there's no risk to your principal. Indexed, that's how your account is credited. That's how you get interest and or you get growth. Usually the indexes that are commonly used in a fixed index annuity are going to be somewhat based on the S&P 500, maybe the NASDAQ, global markets. But again, an index is where it connects to that stock market piece on how you can get growth inside of that account, okay? And the last word, annuity, all that word means is income, which then brings me to the fourth type of annuity, deferred annuity. Now, oftentimes somebody will say, well, Alex, I don't like annuities. I'm like, well, that's interesting. How do you feel about your Social Security benefit? I'm like, well, I love my Social Security benefit. It's a monthly paycheck. Well, that's a deferred annuity, right? Your pension, deferred annuity. So if I just kind of quickly go through the 4 types, they all have different purposes. They all fit different people's needs. So it's really difficult when somebody who maybe isn't as educated on the subject is saying, hey, I hate all annuities or I love all annuities. They're all very different. So you gotta understand the difference and how they all work, how they do or don't fit into your personal situation with financial planning. Again, a variable annuity, there is risk, and again, there can be fluctuations. A fixed, that is similar to the CD where, hey, it's a certain amount of term, it's a fixed rate. Fixed indexed annuities, again, there's no risk with this, but you do have some tied to the stock market. Pertaining to good years, you will have growth. Again, there are some things you need to understand. A bigger conversation, I mentioned riders earlier. Riders, participation rate, caps, These are the details that you have to dig in. Again, I don't want to go too deep down the rabbit hole, but if you have an annuity, if you're looking into annuities, you absolutely want to make sure you're talking to an expert who can help educate you on this subject. And again, those fourth type annuities, a deferred annuity, and that's as simple as a Social Security benefit and or a pension where you're getting a monthly income. So I hope this helps a little bit, a little beginner class here on Annuities 101. If you have questions, if you have any comments, please drop them right here in the post and or message us and we'll be happy to get back with you. Again, I hope you enjoyed this segment of Ask Alex. We'll see you next time.